2025 and also 2030 as well, so that you've got 3 data points and basically you can see that upward trend. I think that really, really underlines the increasing importance and relevance of what we're doing, and it does get us profile, and it also influences the attitude of those organisations to us, which is really important. So please, everything you can do on that would be greatly appreciated. Okay, so with that, I think we're now on the hour. So welcome everybody to day 3. I think we had a good discussion and started on measurement yesterday. We now move into the section on the agenda, which is really looking at measurement techniques in detail for the first time. And I'll hand over to you, Dave, to start off on that with paper 7.2.4.
Thank you, Chair. So as Ian just mentioned, we'll be starting with agenda item 7.2.4, current value model measurement techniques. I don't have a lot to add background-wise outside of what's in the paper on staff's recommendation. When we're doing our research, there wasn't much that we found beyond the 3 measurement techniques that we're proposing. I do have a little background on the way we set up the hierarchy. When we were developing the hierarchy diagram that's in the paper, we did have different iterations of it. The first iterations were more detailed. We had lines coming out of each measurement base allocated to measurement techniques, but it became fairly complicated fairly quickly, especially on the historical cost side. Going through that process was helpful when we actually got to evolving our thinking on historical cost. But as it relates to the allocation of measurement techniques within the measurement hierarchy diagram, what staff eventually realized and what we're actually proposing is to back off actually allocating within the diagram. We thought it was, by just indicating what the measurement techniques are at the bottom of the diagram, we thought was a more conceptual approach, which is actually what we were trying to do with the diagram. So staff's recommendation here is to include the following 3 measurement techniques: market approach, income approach, and cost approach as current value model measurement techniques in the measurement hierarchy.
Thanks, Dave. So you've made the recommendation in terms of those 3 models, and being clear that in terms of, as we'll see later, this is the generic techniques that we're talking about. The specifics of how they would apply to each of the bases we will cover, because those are dealt with in the appendices to the draft standards. So we're looking at the generic techniques at the moment. So anybody disagree with staff's recommendation on those 3 techniques? Camira.
Thanks, Chair. I actually agree with the recommendation. I just have 2 comments. First, it was not clear from the paper why we are naming it cost approach instead of replacement cost approach. I know that there is another paper in the agenda that also discussed that, the consistency between both approaches, the paper 7.2.11, but I think it's important to distinguish in the terms of that is the cost approach, as in the definition it refers to the equivalent asset, because for a preparer that sees for the first time this hierarchy, they might get confused that it's maybe the current cost of the asset that they have and not the cost of an equivalent asset. So if we do not want to mention the replacement cost, maybe another word that helps us to distinguish between the historical cost and this cost approach. And I understand the reasons why we are not allocating now, attributing measurement techniques to the measurement basis. But I think maybe after our discussions in this meeting, it's important to do that attribution, because otherwise we lose the hierarchy. If a preparer starts saying, okay, I'm in the current value model, and now I'm in the fair value basis, and then they say, okay, and now where should I jump to? Now it depends. I will choose a technique depending on the data available, but then it will be go the other way around. Okay, depending on the data I have available, then I decide a technique, and then I randomly allocate which basis I'm using. So that's why maybe we can try with some visualization options to improve. Maybe I know if we use arrows, it will be very complex. It will make the diagram complex, but if we just use boxes and make a list of all the measurement techniques that belong to each measurement base, that will be helpful for the people who will use the hierarchy. So that's it. Thanks.
Thanks, Camilla. I think you're right. I mean, the whole communication exercise around this is going to be really important. So I think if we have that as an instruction for staff, that we need to think about how we clarify early on which measurement techniques would relate to measurement bases. And as you say, there may be an option with a table or something like that to sort of help with that, because then that would be consistent with the more detailed explanation in the appendices. So I think that's, you know, we can have that as an instruction, and I guess if we can hold the comment about the title for the cost approach for now, you know, and let's come back to that, because we do need to be clear on terminology, recognise that. So thanks. You know, I think we need to keep coming back to that. How do we make all of this workable for our constituents? Okay, so I've got Lynn. I'm going to take members first. I'm not looking for additional comments from staff at the moment. I want to take comments from members first. So I'm going to go to Lucy, then Lynn, and then Ajif.
Yes. Thank you, Chair. I agree with the staff recommendation to include the three measurement techniques in the IPSASB measurement hierarchy. Um, However, aside from providing commonly used measurement techniques for each measurement basis in the ED, I suggest that explanation on the factors to consider when selecting a measurement technique be included also, just like similar to what Camila had said. And further, since this is measurement hierarchy wherein we prescribe an order, um, perhaps the staff may also provide for the most likely, not strictly corresponding measurement techniques to be used for each measurement basis, but this will serve as a guide in the application of the hierarchy from the measurement model tier down to the measurement techniques tier. Thanks, Chair.
Thanks, Lucy. I mean, I think some of these comments, really, we need to see what the drafting ends up looking like. I mean, I can understand where you're coming from on that, trying to indicate which techniques will be most prevalent, but I think we will have a problem in doing that, because we're setting a principle-based standard, and we need, you know, it will vary depending on circumstances, not only between jurisdictions, but also within items as well. So I think we're going to have a problem with that, but I think see what the drafting looks like, and then we'll see whether there's any further that we can go on that. Okay, so I've got Lynn next, and then Ajith, Nima, and Michelle.
So do I agree with staff recommendation? Yes, I think there are market approaches, income approaches, and cost approaches. I had a question mark in my mind whether the cost approach would always be replacement cost. For example, amortized cost is used to measure in current value models as well as historic cost models. So I just wanted to make sure that we describe the cost approach in an appropriate way. And I had a question mark once you move outside PPE, whether or not it was always replacement cost.
Okay. And can we hold that, because we are going to have the debate on replacement cost, and I think to an extent, you know, we're going to have to look at communication when we see the whole document together, and then say, okay, does this work? But appreciate we do need to be very precise about what we actually mean. Okay, so I got Ajith next.
Thank you, Ian. I think I agree with the staff recommendation of the techniques related to market approach, income approach, and cost approach. However, after yesterday's discussion on the initial recognition issue, there was a trend of thought that I had, which I think I'll share with you, which probably fits this agenda item as well, which is that the hierarchy actually doesn't seem to apply for initial recognition. That's what I felt. And in fact, when you think a little further,
I think we need to see what comes back on initial recognition, because I think there are a number of different comments on that, and I'd rather that we wait and see what comes back on initial recognition when we see the drafting. And I think this is common across a lot of the comments. Basically, what we're looking for at the moment is, in principle, are you okay with this in the context of the hierarchy? Initial recognition, I think we need to have that discussion when we see the drafting, because members had a number of comments and a number of concerns about that, and I'd like to pick those up at that stage, if we may. You know, recognising that the techniques discussion will impact on that. Some of what goes elsewhere will impact on that. So I'm just concerned that we keep moving at the moment, rather than pick up specific points on things that we haven't yet seen drafting on, and we will see that back later. That's okay.
Yeah, that's fine. No, I was what I was trying to say was that while I was thinking on that, what I felt was that doesn't really apply for the subsequent recognition as well, because when you look at the subsequent recognition issue, if you look at the items that we're using as bases, fair value base, value in base, value in use base, are actually used in the historical model context as well. So it's not the model related difference that we are seeing, but it's more in relation to the current value bases and historical value bases. So what I felt was that the model-based looking at the hierarchy didn't seem appropriate, but because these bases that we're using on the current value side is actually used for historical value as well, because value in use is actually used for the historical value base. Is historical value model, historical model, cost model, and not really in the current value model. So now I feel that the model based separation is not appropriate, but I think the separation based on current value bases and historical cost bases, that is the difference that is highlighted, because it's useful to have the current value bases separately identified and separately grouped, because then we can use the income approach, market approach, and cost approach. These techniques apply to the current value bases and not for current value model, because in historical model context as well, we use the value in use. Value in use is actually mostly used in the historical value model, not in the current value model. So it's not a model-based difference that we see, but I feel that it is more current value bases and historical cost bases where the difference lies. That was the thinking that I had. I thought I'd share with you.
I mean, I think, you know, basically at the moment, what we're trying to do is focus on the current value basis. And what I'm hearing from members is support for the three techniques here, we are going to need to have a look at how all this hangs together. And there are some complexities, but I think we need to see the drafting first and then see whether there's an inherent problem. And the reason why we came up with the idea of techniques separate to bases is because precisely what you were saying, that actually things can be used in various different places. And that's why we need to get clear on what the generic techniques are and then look at how they're used in practice and get that discussion clear. So again, I think if we can hold that one, because we will have a discussion on historical cost in a minute, we need to get clear on current value measures at the moment, if that's okay. So I've got a final comment from Michelle.
Okay, I put my microphone on. I just wanted to support Camira's former comments about the link between the basis and the techniques. I had a long discussion last week with the preparers of the French state's financial statements, and their opinion is that at that stage in the hierarchy, the basis stage is of no use. It just confuses. The way the preparers act presently is just they choose between the model, if it's a historical or current value model, and once they have done that, they go directly to the technique. And presently, if you read carefully the documents we have, the basis stage is of no use. It's purely philosophical. It's so either we do, as Camira's suggested, we bring a clear and strong link between basis and techniques, or if we leave it as it is, the basis stage is not needed. It just brings confusion.
Thanks, Michelle. I mean, I think it all underlines the fact we need to see the package. Now, let's not reopen the hierarchy itself, because we did agree that last meeting. I think we need to see the communication, and I think Camira's point is very valid, that we probably need a table or something like that, which sits alongside the diagram, which will give you clearer indication of which techniques are relevant for which basis. And we've got some further debate to go on the bases themselves. And I think we are moving towards clarity for preparers, but we've got some way further to go. So I think we need to keep testing this. But I think if we can ask staff to focus very clearly on the communication aspects within the document, so it is clear on what the thought process would be and how that's operationalized. Because ultimately that's what we're trying to do, is provide much clearer, more intelligent guidance that helps people work through and helps them decide how they brief their valuers, where that's appropriate, or helps them decide on which data are better than other sources of data. So I think we still need to see that drafting, and then we can come back and have these, the discussion next time round. Okay, so finishing off on this debate, I think that communication piece very strongly comes through, that we've got to see how these ideas really fit together in practice. But going back to the original recommendation, I think we got support from members for those three approaches for current value model. So within current value model, support for those three approaches. Okay, so now we'll look at historical costs, and this will certainly be impacted by the discussion that we had yesterday about whether, about the approach to valuation on initial recognition. John, can you take us into that, please?
Yeah, thank you, Ian. At the last meeting, the hierarchy was agreed subject to clarification that the historical cost model does include measurement techniques. The only measurement technique that we have identified for historical cost is amortized cost. And we accept that that is challengeable. because one of the components of amortized cost is impairment, and elsewhere we've said that impairment is not a measurement technique. So the staff recommendation is to include amortized cost as a measurement technique for historical cost, but that is put forward with the full knowledge that there is an alternative view here, and that there is some question mark as to whether or not historical cost does involve techniques. As the chair said, that's parking the issue of the approaches to measurement at initial recognition that we talked about yesterday. The explanation of what amortized cost is given in paragraph 10. Further, staff have considered whether net realizable value and value in use are measurement techniques supporting historical cost, and have formed a view that they are current value measurement bases and they're not techniques. So the recommendation is at paragraph 2, and at that point I'll leave that open through the chair for discussion.
Thanks, John. And I think we have to recognise the impact of yesterday's discussion on this. So I'm looking for comments at the moment, rather than necessarily that we will come to a decision, because I think we have to see the drafting. Lucy, first.
Thanks, Chair. Actually, I intend to disagree with the staff recommendation, and as mentioned by John, this is really it is challengeable. As defined in paragraph 9 of IPSASB 41, the amortized cost of a financial asset or financial liability is the amount at which the financial asset or financial liability is measured at initial recognition minus the principal repayments, and then adjusted for any loss allowances. Now, following the definition and applying the same logic that was used in the analysis of value in use as not being a measurement technique under historical cost basis, and that was explained in paragraph 11. The amortized cost of a financial asset or financial liability also includes an adjustment for impairment losses whenever indicators of impairment are present. Therefore, the recoverability of the financial asset or liability is also determined, just like in the value in use. So this might effectively place amortized cost outside the scope of historical cost basis. So I would like to opine that it is not a measurement technique under the historical cost basis. Although in the 2020 IFRS conceptual framework, it says in paragraph 6.9 that one way to apply historical cost measurement basis to financial assets and financial liabilities is to measure them at amortized cost. So I really struggle on this, because following the logic in value in use, that it is outside the scope of historical cost. So maybe amortized cost may also be not properly a measurement technique under historical cost model. Thank you.
I think that, that concern sort of echoes some of the comments that were made, that we need to make sure that we look at this from the financial instruments and the liability perspectives, not just from the PP&E perspective. So I think, what I'm going to do is collect instructions for staff to consider in taking this issue forward. So I think that's a clear instruction to think about that from the IPSASB 41 perspective. So next to Camira and then Lindy.
Thanks. I'm just wondering, with amortized cost, we are only focusing on financial instruments. So it's possible that people will ask for also a measurement technique for for inventories, PP&E. If you offer something for financial instruments, then what happened? And also something that we should also give more thought about is the linkages between the initial recognition, I mean, in this case, well, the transaction price, and now this amortized cost, for instance, because then it's not clear. Because in amortized cost, we are discounting the future cash flows. And then you say, well, what is the relationship, this measurement with the initial transaction price? So thanks.
Ian, you're on mute. We can't hear you.
This is definitely the catchphrase for the year. Yeah, so yeah, no, it's good intervention. Thanks for that. And yes, I think that's an instruction for staff, that we have to look at that side of things in terms of property, plant and equipment held at historical cost, in terms of how that fits with initial measurements on initial recognition. Okay, so I go to Lindy next, and then Mark.
Thank you. So I also disagree that amortized cost is a measurement technique for historical costs. I don't think it should be included at all. And for the same reason that John expressed on the impairment, but also because in amortized cost, you could have an interest rate with a variable component. And that means that every time you measure, you actually are adjusting the value, which then goes against what we're saying on historical cost. What we were thinking is, well, a technique for historical cost could be a discounted cash flow approach, but where you use historical inputs and nothing changes. So something similar to what is being said there, but where you don't have any adjustments for variable rates or amortized impairment, for example. So maybe a variation of that, but definitely not amortized cost as defined in IPSASB 41. Thank you.
Thanks, Lindy. Mark.
Yes, concerning the question whether the amortized cost is a measurement technique at all, I would say yes, it is, because a measurement technique is a method to estimate the amount at which an asset liability is presented under the selected measurement basis. And as the amortized cost uses the effective interest method, I would definitely say it's a technique. However, on the question to which model it would apply, I see the point, but I would also like to take into account that in the effective interest method, the discounting of the cash flows always occurs at the historical rate. And I think this is the big difference to, like, say, a DCF method, where you would always use a market rate. You can also value the bonds at market rates, then you get the fair value. And so I would definitely not just say it is a current value. So I see the arguments, but I would have so far rather subsumized it as a historical cost technique. However, what I also wanted to bring in is why the amortized cost is proposed as the only one under the historical cost model. But what happens actually with let's say just a normal PP&D, which is depreciated over a lifetime? Where would this fit? Isn't this a technique, or where would we find this case? Because I think this is the common case, and I missed it somehow. So the question isn't it a technique?
Thanks, Mark. And I think that clearly is general, because you also depreciate assets held, or PP&E held, on a current value basis as well. So that is a good question. Ajith, and then Todd, and then Lynn.
Yeah, thanks, Ian. I agree with the staff recommendation that amortized cost comes under historical cost basis. But I also thought that costless depreciation, or the depreciated cost, would also come under historical cost as a measurement technique for under historical cost. Thank you.
Sorry, Ajith, I missed your last part of that.
Yeah, that I thought that costless depreciation or depreciated cost should also be considered as a measurement technique on the historical cost basis. That was my view.
Okay.
Thank you.
Thanks for that. Todd, then Lynn.
Thanks, Ian. I'd just like to support, I think, the comments that have already been made. When I thought about the recommendation here, I certainly wasn't agreeing wholeheartedly that, you know, that we should just have amortized cost as the only technique against historical cost. And in my mind, it comes back to, I think, a point that Lynn might have raised yesterday, that we have to be able to think about all the various liabilities and assets and make sure that it resonates for all of them on both the historical cost side and on the current value side. And I think, you know, didn't make any comments when we were talking about current value, because I think, you know, we've got three techniques that seem to work on that side of things, but it didn't quite work for me just to see amortized cost in a financial asset and liability sense on the historical cost side. So I think we do need to do some more thinking and make sure that we get this right, so that you can think about and see the historical cost techniques across the range of assets and liabilities.
Thanks, Todd. Lynn.
Yeah, just to on what Todd is saying, but also what Michelle said earlier. So 2 points from me. Driving it under historic cost, I think, is misleading. And so
You're breaking up, Lynn.
Lynn, you may have to go out and come back in again.
Yeah. I think whilst Lynn's doing that, I mean, I'm clearly not hearing support from members for amortized costs as a measurement technique under historical costs. I mean, I think members have clearly said any techniques appearing here need to be applicable for property, plant and equipment, financial instruments, and liabilities. I think we are certainly, there is a question about what the picture looks like when if you deal with initial measurements on initial recognition separately. Then the question for historical cost is there anything else after that? And then the third question, which I think is a very interesting one, which is actually, what is depreciation? Is that a measurement technique, or what is that? Because that certainly impacts on the historical cost model values, but it also is relevant in terms of current value models. So I think we just need a view on that, which may come back to, actually, there aren't any specific techniques that we need to put under historical cost, because essentially it's what you recognize it at initially, and then you just depreciate it and do your impairment review. So I think we need a view on how that fits, that all fits together, but bearing in mind that overall exaltation in terms of the PP&E, financial instruments and liabilities. Okay, I think we haven't got Lynn back at this stage, so I think what we need to do is keep moving. If I could ask, though, just in terms of in the interest of keeping moving through the agenda, if members, what I'm looking for is where members disagree with the staff recommendation. If you agree with what a fellow member said, that's good. Please just use the thumbs up. We need to minimise the number of interventions, in order to keep moving through this material and give staff direction. We've got a lot to cover. Okay, so I'm going to move us on now to market approach.
Thank you, Chair. Just wanted to give a quick summary because I'm aware that we are short on time. As Dave mentioned earlier, staff recommended 3 measurement techniques under the current value model. Now, because measurement techniques are will consider the attributes of bases, some techniques may be applicable to multiple bases. So staff are proposing that the guidance would be a little bit more generic so that it can actually apply across multiple measurement bases.
Thanks, Eileen. And sorry, I should have said welcome.
No problem.
And just to say that because this has been handled as a team approach, you've already seen Dave and John present, but Eileen will also be presenting a number of the items during the day. So really, this is the first time we've met the recommendation that we will have generic guidance on the techniques generically, and then consistent with the comment that was made last time around, I think particularly by Todd, then under each of the bases, you will look at how that is specifically applied in that context, depending on how it's used. So does anybody disagree with this approach that we have generic guidance and then the specific appears in relation to each of the bases? Lucy.
Thanks, Chair. Actually, it's not, I don't disagree. I agree. But since we said that the market approach description developed for the CP will be generic to all applicable measurement bases, which means current cost, fair value, cost of settlement, or value in use. Conversely, there should also be statement under the fair value AG that aside from the market approach, the income and cost approaches may also be applicable to fair value measurement depending on the data available and professional judgments. Thank you, Chair.
Thanks, Lucy. Eileen or Dave, can you just clarify? I think that is there in the appendix, but if you can just clarify.
Yeah, absolutely. So Dave, I can start, and then if you wanted to add anything. Okay. And so for the specificities within the guidance that has been previously proposed in the CP, those would actually be in the application guidance appendices for each of the bases. And depending on the results of this September session as well, we will be proposing additional documentation based on whether the board agrees on the techniques that are available under the bases. So we will be presenting 3 different papers later today that will be going through that. Dave, did you have anything else to add?
I was just going to specifically say that yes, market approach, income approach, and cost approach will all be applicable under the fair value measurement basis.
Mm-hmm.
Okay, and that's consistent with IFRS 13. Thanks, Dave, for that. Okay, so I'm not seeing any other flags raised on that, so I think we agree with staff recommendation on that. So Eileen, move us on to the next paper, please.
Thank you, Chair. So the next paper is about the use of market approach, and this is the first of the 3 papers, one for each of the approaches, to discuss what staff determines as possible technique applications to the bases. So in June, the board agreed that the techniques are methods to estimate the amount at which an asset or a liability is presented under a select bases. Now, as noted in the draft ED, entities should select a technique that best meets the objective of a basis by considering best use of available data, how to reflect attributes applicable to the basis, and also just to consider the importance of professional judgment in determining the most appropriate technique for each transaction. Now, while we were writing this paper and conducting the analysis, staff spent considerable time thinking about the best way to determine which measurement techniques are appropriate to estimate which measurement bases. And for For market approach, we chose to, for all approaches, we chose to focus on what data each technique would provide and how useful that would be for each basis. So for market approach specifically, this approach uses data from current market transactions. And so we felt that this approach provides the most appropriate data for any bases that intend to reflect what an entity would pay or receive for an asset or liability in current market conditions. Based on that, we're proposing that market approach can be applied to estimate fair value and current cost.
I'm signing. Any members disagree with staff proposal on that? Mike.
Thanks, Chair. I don't know whether I disagree or not. I'm trying to get my head around the current cost argument. So if I'm valuing a road that's been there for 50 years, how would I apply current cost in a market sense, where there isn't a market for a road?
I'm not sure that you would, because you've got other techniques available to you, Mike.
I have, so I could use fair value, but then why would I even think about current cost? Are you saying it's just another option? Yeah, okay.
Yeah. And I think this comes back to, Camira's point that we need to highlight the options, but then the appendix giving guidance on that basis will say how you approach it. Camira, do you want to come in before I go to Dave on this?
Yes, I only have doubts I'm not very convinced of the difference between current cost and fair value, because I know we will discuss that in the later agenda items, but basically we are measuring the same from different perspectives. So in fair value, we are taking the perspective from the seller, and in the current cost, we are taking the perspective from the buyer or the entity. There might be difference because yes, but I would say that current cost could be a proxy for fair value. So that's why but probably we will discuss more on that in the following agenda items. But in the allocation of market approach to fair value, I agree. So thanks.
Thanks, Camira. Yeah, I mean, I think this is where we're picking up the individual parts of this, and we will need to see how the whole comes together, but we've got to go bottom up because the concern I had as from the board's behalf was that actually we'd focused at the top level, and a lot of the issues actually lie down at the bottom. So actually that was the reason for going bottom up for this session, to really get us the chance to debate. Dave, I'm just going to allow you to come in for a minute to clarify before I go to Patricia.
So Mike, I just wanted to come back on your comment because I thought it was a good example. If you had a road that was 50 years old, I think the standard would indicate which measurement basis to apply. So whether it's current cost, fair value, or cost of settlement, or value in use. But you would then have the option to select the technique that best estimates that basis based on the data available. So to your point, if there's not a market, you wouldn't use the market approach, you would use the cost approach or the income approach. So that's where the selection happens, down at the technique level, and you select based on the data that you have available.
Thanks, Dave. I'll go to Patricia next.
Thank you. According to the rationale used here, the market approach has generic principles, and then it is possible to adjust according to a specific technique. In the case, I agree if I can use a market approach for fair value and current cost, but I think it is possible too for cost of settlement too, because the entity can settle the obligation by negotiation in the market, and then it's possible to adjust the market value of the liability with the specific characteristics of the entity. My question here is about the cost of settlement. And in my view, it's in the follow item of agenda. I think the income approach is more difficult to conciliate with cost of settlement. But in this in the adequate moment, I comment about this.
Thanks, Patricia. That's a good question. Now, I think just from a point of view of running the discussion, actually, if I can ask that comments come back from on the staff side from whoever is actually presenting the paper, because if there are points within staff, I'd rather that the person presenting just made those comments rather than we end up with a free-for-all. So Eileen, I don't know whether you've got any observations to make on that cost of settlement point, or cost of fulfillment, I should say, given we agreed we weren't going to use cost of settlement, or is that something we should take away as an instruction?
Yeah, when we were doing the analysis, we definitely did think about the same point that Patricia made, so we do appreciate you brought it up. When we thought about cost of settlement, it was more entity specific, but the market approach would work for transferring an asset, and you don't really transfer a cost of settlement, you would settle with a counterparty, and so that was a reason why we felt that market approach wouldn't necessarily apply.
Thanks, Eileen. Tricia, do you want to come back on that?
But the market approach, it's a quoted price. For example, quoted price is a way to define the value, and I quoted price for assets and liabilities too. And the examples, I'm not sure, but I can confirm. But the examples in IFRS 13 approach the liabilities too.
Thanks, Patricia. Lindy, are you on this point, or are you separate? Yeah, go ahead.
And I wonder though if what is being described is rather the cost of release rather than the market approach, which we said already is probably not common or often used for the measurement of liabilities. So I don't think you can have something like a market approach for liabilities. I think what we would have used as a cost of release would have been something similar, which I guess we still would get to now, but I think we said it's not commonly applied as a technique.
Okay, so I think in terms of conclusions, getting support on the asset side for the market approach for current cost and fair value, but we clearly have some concerns, and Patricia, you've articulated those, about how this fits from a liability side, and whether that fits with cost of fulfillment or another basis. So I would suggest that we have the debates that we're going to have about bases on the liability side later on today, but there's an instruction for staff to follow up on this, specifically on market value, as to whether there is a, it is relevant on the liability side or something else. So I think that's the instruction to staff, that the decision is in favour of market approach and current cost and fair value, but to be followed up on the liability side. It's the instruction. Okay, so Eileen, can you move us on to the next topic?
Yep, thank you, Chair. So for the income approach paper here, it does mirror what we are proposing for the market approach, so I won't say too much more. Mainly, we are recommending that income approach description from the CP be made more generic, and any specific portions of the definition would be within the actual application guidance itself. That would allow for the income approach to be applicable across multiple bases.
Thanks, Eileen. Any members disagree with that recommendation from staff? Camilla.
Yes, thanks. Just in this point, it's about the name. We are calling it income approach, but in one of the descriptions we give, we also refer to expenses. That will be a bit inconsistent with the title, because it says it refers also for cash flows or income and expenses. And in that case, maybe can we just name it something else, maybe present value approach, that will be more general for all type of cash flows? Thanks.
Eileen, do you want to come back on that, whether you considered that? Otherwise, I think that might be an instruction to go away and have a think about that, because that might just be a drafting issue that we need to deal with there.
Yeah, we'll definitely take it away and think about if the wording change would make sense. But I do believe the wording we've used now is actually in alignment with IFRS 13.
Okay, so I think if you can take that away then, Eileen, and have a further discussion with Camilla as necessary on that. Okay. So Patricia next.
Yes, one comment about the Camilla comment is a key. When I think about the income approach, I think in the return of investment, and then I conciliate revenue and expense to try to calculate the value in present moment, for example. Then I think here it's the same in IFRS 13, but the idea is to conciliate the inflows and outflows in sometimes according to the oh, sorry, I forgot the name in English. Sorry, not in the cash base, but in the no, sorry, accrual base. Sorry, sometimes I forgot the term in English, but in accrual basis. Then I conciliate the flow of the benefits of in the investment in terms of accrual base, considered revenue and in expense too. I think it's because these, and I think because these are my next comments in next item.
Okay, so really building then on what both of you have said, that we might need to explore something like a cash flow based or something like that, but as you say, that doesn't quite work for an accrual environment. So if we can leave that with staff, that you need to think about it. Obviously the drafting comes from IFRS 13, but we need to make sure that the terminology works for both inflows and outflows, if I can say that. Okay, so in principle, yes, but we need to work out, you know, whether there's a need for change or anything like that. Rod.
Thanks, Chair. I just wanted to say to Patricia that I find her English excellent and I find her comments very helpful. So thank you very much for all of your comments. Thanks,
Rod. Yeah, I think it's good to give that feedback. And please do keep battling. You know, we appreciate what you're putting into the debate. Honestly, that's appreciated by the members, so thanks for that. Okay, so I think agreement with staff, but we need to, it's that sort of terminology drafting and the tension with IFRS 13 that needs to be resolved when we see that come back. Okay, so we move on then. Dave, are we over to you at this stage?
One final one for me, actually.
Okay. Sorry, I think.
No worries. Thanks. So not too much to say here that I don't think I've already sort of related to. So similar to the market approach use, we really thought about what data this technique would provide in terms of the best estimate for each basis. And now for the income approach, this really estimates future cash flows, both inflows and outflows, and also considers variations in time value of money. So when we thought about that, that means the income approach provides the most appropriate data when estimating a measurement basis that intends to reflect value based on future amounts. And so with this, we felt that market approach would be applicable to all 4 of the bases that we've proposed.
Sorry, you meant income approach.
Oh, sorry, yes, I did mean income approach.
Yeah, okay. So, I mean, in discussing this, obviously we have the caveat, as Patricia, said, in terms of the discussion that we've had about the title for this. But I think the question is, does anybody disagree with the proposal that this is applicable to those 4 bases? Patricia?
Yeah, I'm not sure about the in relation to the cost of settlement. One moment, please. And current costs, because the perspective is entry value and not in, sorry, the income approach, the perspective of income approach, it's the entry value and not the exit value, and the current cost and cost of settlement is in the perspective of the exit value. Then initially I think it's not adequate because the concept of income approach. But I think it's need to think about this point.
So Patricia, just following up on that, is part of it just how it's used in the context of the basis? Because remember, at this stage, we're discussing the generic, can you use this sort of approach generically? Then there will be the specific guidance under each of the bases about how do you use it. And for example, are transaction costs, do they need to be taken into account depending on whether it's entry and exit? Is that the nature of the concern that you're expressing?
I think not the specific guidance. I think it is indeed it is the generic principle, because when in the item of agenda about the to eliminate some I can recover here. Eliminate the evaluation of the liability in the perspective of entry value. It's for me it's the same. I can assess or I can measure the liabilities according to income approach with my perspective in relation to entry value, not in relation to exit the operation, exit to the obligation, but entry to obligation. I think it's okay, but to exit of obligation, I think it's not okay in relation to cost of settlement. And in relation to the current cost is the same, because I think about the entity that want to buy or to obtain the assets, not to not related to benefits, related to the assets. I think because this is not adequate, but it's in the general principles, not application.
So Todd, are you on this, or shall I go back to Eileen at this point?
I certainly had a question mark when thinking about whether the income approach would get used under current cost. I don't know whether I necessarily disagree, but I certainly had a question mark over whether there would be circumstances where you would actually use the income approach. Certainly thinking where current cost might get used at a standards level, dealing with physical assets in the public sector, are you going to end up in an income approach because those assets are unlikely to have cash flows associated with them? So just a question mark over the current cost for me.
Okay. David, I'll go to you as task force chair and then back to Eileen.
Okay, thank you. Sort of listening to this debate, I wonder actually whether it goes back to Camira's point actually about what we call it, because if you look at the table both in paper 7.2.9 on pages 30 and 31, under both current cost and cost of settlement, they're talking about cash flows rather than income, so it could be expenses. So that would be appropriate for cost of settlement or for, cost of fulfillment. It would be appropriate under current cost. So I think the previous instruction to staff to go away and look at actually what we call it might well help quite a few of these points.
Okay, thanks, David. Eileen, anything to add?
No, actually, David kind of took the words right out of my mouth, because I think what we were trying to communicate in the paper, and it might be that we didn't communicate it very clearly since there are quite a few comments on this, is that with the income approach, we're really focusing on how it provides data about future amounts. And that can come down to cash flows as well as kind of the accrual component that Patricia was mentioning as well. So if we think about it from that cash flow perspective, both in and out, then we did feel that current cost and cost of settlement could be measured using this technique. But I do recognize Camira's point. I think the wording that we're using for this needs to be revisited to make sure that we can alleviate some of that confusion.
Thanks, Eileen. And perhaps by way of comment back to Todd, I keep coming back to social housing, where I might use an income approach to value an item and that wouldn't be market because it would be at a below market rental. So in that case, I might be valuing on the basis of an income stream. Mike, and then I'll round us up.
Well, so I suppose, Ian, to an extent, you've answered my question, because I think go away and let's get the terminology right, but then give us a few examples of how this might be applied in practice, because you've thought of one, I couldn't think of one, where I would use an income approach to current cost.
Okay, so I think on that, I mean, we do need to get the drafting right on this, and I think there is a question mark about the name, as David has has come out. I think in terms of an example, I've proposed that one off the top of my head as an example of where I would use a cash flow based technique, but I think we need any examples of how where that would be appropriate in practice in order to convince members on this. And if members do have any examples, then please can they let Eileen know on that. But at the moment, social housing would be my suggestion. Todd.
Todd, you're on mute.
Can people hear me? I think I'm having a few problems with connectivity. Okay. Your example, Ian, sort of raised in my mind that we may need to have a conversation at some point about the current cost and the way that we approach it. Because if you think the fair value measurement has the hierarchy, and I'm not sure whether we're intending to have a hierarchy in terms of the current cost measurement approach, because if we were, then I don't know whether I'd get to the income approach for your example of social housing, because there will probably be market transactions around housing, and so there might be a market that you could look to. But we don't need to have that debate now.
Thanks, Doug. Well, maybe we can hold that one because we are going to have a discussion about current costs later, and it is a fair point. Okay, so for now, we have that overarching point, I think, on this one, which is that we need to sort out terminology in the drafting and tension with IFRS 13 and so on. And that, you know, is clearly, the title income approach is clearly giving problems in that respect. And then I think in terms of the recommendations, certainly there is a question mark at the moment over current cost. We need, you know, examples in terms of how that would, you know, just when you might use that. So I think those are the instructions to start on that. Okay. So in principle, yes, but subject to resolution of those points. Okay. So I think we are on to you now, Dave. Is that right?
Correct. I was just going to say, Ian, on examples, I hadn't appreciated this, but within staff and within the task force, we use examples all the time to talk through these, and these don't get brought to the board. So we can definitely put something together to show what we're thinking. And I just hadn't appreciated to bring that to the board. With regards to 7
I mean, I think responding to that, you know, I think it's always easier to think about it in terms of, you know, concrete examples. So yeah, thanks.
With regards to 7.2.10, as Eileen mentioned a couple of times now, these kind of papers are similar, the three approaches. So I don't have much to say except we took the generic approach for cost approach and then looked at the fair value specific guidance and took some fair value specific terminology out to make it generic so that cost approach could be applied again across all measurement bases.
Thanks, Dave. Anybody disagree with that? No? Okay. So we accept that recommendation.
So just a quick heads up to members. What we did was we switched the order of 7.212 and 7.211. In reading the papers, we thought it was very important that you read 7.211 first, but in going through the issues, we thought it would be easier to conclude on 7.211 after we concluded on 7.2.12. And that's because the issue of 7.2.12, from a reading perspective, comes out of 7.211. But again, it's more difficult to make the conclusion. So 7.212 deals with service capacity compared with service potential. And as I said, this is an issue that was identified coming out of the next paper where we compared the cost approach to replacement cost. And when we were going through that comparison, the only difference of substance that we noted was service capacity was used in the context of cost approach and service potential was used in the context of replacement cost. This is a good example of an item that went to the task force and they helped, I think, give us a better path forward. When we were comparing the cost approach and replacement cost, the principles, and I'll get into this in the next paper, but were consistent except for this one point. And we discussed originally about selecting either service capacity or service potential and just using that generically throughout ED measurement. But you would interpret it differently depending on whether you're trying to come up with a valuation from a market participant perspective or you're trying to come up with a valuation from an entity specific perspective. And what the task force actually ultimately led us down was it was still appropriate or more appropriate to use separate terms. So we would use service capacity when we're trying to come up with a market participant perspective, because we felt that when you were trying to come up with a market participant perspective, what market participants are most interested in is the value of the asset or liability on the open market. So what is the service that can be provided by the asset? So if you have a hospital that can serve 500 patients, that's what they're most interested in. Whereas if you're looking at evaluation from an entity-specific perspective, what they're most interested in is the current use of the current services being provided by the asset. So if you have that same hospital that could potentially provide services to 500 patients, but is only providing service to 300 patients, that's what's most relevant in an entity-specific example. So as a result, we wanted to clarify that there was two concepts we were trying to ground in the two different types of measurements we were coming up with, and that's why we landed with service capacity for market participant valuations and service potential for entity-specific valuations.
Thanks, Dave. So I'll open the floor for comments on that. Yes, Camira.
Thanks, Dave, for the explanation. And yes, I agree that there is a difference between service capacity and service potential. Looking at from the market perspective, okay, service capacity is, let's say, yeah, how much, if you are asking for a quotation or we are asking for, yeah, for a new asset, I need, I don't know, a school with capacity for 500 students. And from the perspective of the entity, the service potential would be, okay, I need a school for 300 students. But at some point, both service capacity and service potential should match. Otherwise, it will mean that the entity is not using the asset in the most efficient way. So if we take the perspective from the user of the financial information, there is a school that has capacity, a service capacity of 500 students, but actually there's a service potential of only 300 students. There are only 300 students enrolled. In the financial statements, I would like to know from the user of the financial information, I would like to know the value of that asset in terms of its capacity, and also the school should have as a target from service potential to reach 500 students. So I think in terms of measurement, there should not be a distinction between service capacity and service potential, because the target of the public sector entity should be, if they have available an asset, they should reach their maximum capacity. They should the service potential should reach its maximal capacity. Otherwise, they are not using the asset in the most efficient way. So that's why, well, that's my point of view. So thanks.
Thanks, Camira. I think you're right about you know, it actually is a PFM point here. You know, and another example I've come across is a you know, an expensive aircraft hangar. Military aircraft hangar that was being used as a storeroom, and actually, you know, in that case, it was basically what you would value is the fact it was being used as a store. So actually, there is an impairment because actually that's worth a lot less than a very highly specified aircraft hangar, and I think that's the accountability point there, you know, which is exactly right. But that doesn't, if you like, this is where you're right from a PFM point of view. They should be using the assets as efficiently as possible. But from a financial reporting point of view, what we're actually doing is reporting the fact they're not using them as efficiently as possible. And therefore, in that case, there probably would be an impairment because there would be a difference between the two values. Does that make sense? And I think in discussing it, we should bring out that point that very clearly. You're exactly right on that. Todd and then Mike.
Yeah, I think there is a distinction between the two. In terms of some of the discussion that we've had, I think we're going to need to be very clear about what we mean by the two different terms. And again, I think having some really well formulated examples are going to be quite helpful, because I think we've used sort of shorthand for the hospital that could accommodate 500, but I think I heard someone say, but there's only 300 patients in the hospital right now. But I think it's not just about how many patients are using that hospital now, it's what capacity would you want that hospital to have when you start thinking about not only right now, but sort of for the future. So if you were deprived of that hospital, knowing all the information you have right now, what hospital would you replace it with? Would it be a hospital that only accommodated 300, or would you actually rebuild a 500 patient hospital? Because I think if you would rebuild a 500 patient hospital because, you know, you realise that things like coronavirus are out there and you might need to be able to accommodate an extra couple of hundred people, then I think, you know, you would actually end up where Chimera is, and you'd say, well, the service potential and the service capacity in that case should be the same. So it's the way that we actually explain and articulate this that I think is going to be very important.
Thanks, Todd. Yeah, I think in this context, hospitals may not be the best example to use precisely for the reason that you've articulated. But you're right, we need to be very clear and explain it very clearly, you know, because it is, you do get to that, well, why would you do something, you know, so it's Chimera's point. Right, I've got Mike, then Adrienne, then Lynn, then Patricia.
Thanks, Chair. So I'm finding myself agreeing with Todd and Chimera, and it's a real problem for us in parts of Australia now, where there's enormous growth in parts of Australia and declining regional populations. And schools is the better example, where some schools simply are now not capable of being filled with students. And valuers are saying the value's gone down. So I think it's important that we understand how the valuers look at these things. And yes, would you replace it? Probably not.
Thanks, Mike. Yes, schools, I think, is probably a good example. Adrienne?
I'm not sure how my comment fits into the others, and I'm not sure how much weight you should give it, but just to have mentioned it, in economics, potential is usually the frontier of how much you could possibly expect from a resource. And so the idea of capacity exceeding potential, which I think is the way we've been using it, comes across as uncomfortable. Now, I mean, this is a totally different discipline in that sense, but as an economist, I'm not following this very well, because capacity keeps exceeding potential. And if we're re-looking at this and there were a way of avoiding that seeming inconsistency, it would be helpful to economists.
Thanks, Adrienne. I think that underlines the communication point here very well. I think it is one of those things where, so I think we need staff to look at the communication point very clearly, and then there is a question about whether terminology could be made clearer or not to underline that. Perhaps thinking about not just the accountancy audience, but perhaps a more plain English. So I think that's the instruction there. Lynn, and then Patricia, and then Scott.
So I was just wanting to remind ourselves of when each of these get used, because I thought the paper was pretty clear that on the cost approach, replacement cost, you are talking about the service potential. So some of the issues that have been discussed wouldn't come up. And the service capacity point from the paper is only relevant when you are in effect using fair value, so an exit value. So I wondered if the term service capacity is not that terribly helpful, because actually when you are in fair value under IFRS 13, you are at a value that is the highest and best use for any use. And so I just wondered whether or not we ought to think about it differently, because actually service capacity is just describing highest and best any use on IFRS 13. And I wonder if we're getting ourselves tied up here on something we don't need to be tied up with, because service potential is the only measurement that will be, or is the only sort of measurement that we will use on a replacement cost basis.
Thanks, and I think that's very helpful, and that may well be the way through avoiding using that that term service capacity, because you're right, and then you get into all the discussion we've had about the ED79 project and so on, and perhaps from a stakeholder point of view as well, making the connection there in terms of, you know, that's how you would access that, it would be helpful. Okay, so I've got Patricia and then Scott.
I agree with Camille's comment, and I have thought about the term potential service and capacity of service because in relation to a specific issue of public sector, I think it's very, very relevant. In my view, capacity of service is a characteristic of assets. And when two parties negotiate negotiate an asset, one right or one good, the focus on capacity of service. Then after the negotiation, the entity, the manager, can decide about the finality of the resource, of the right, of the good. The entity can to explore to obtain economic benefits, or can to use it to achieve the objective of entity. And when decided to use it for achieve the objective of entity, the entity decide use whole of the capacity of services or not. Then, in my view, in the item 8I, service potential is identified as a characteristic of an asset. I think it's not a characteristic of an asset, but a characteristic of use of the asset by the entity. But I think it's complicated because it's necessary to discuss the concept of assets in framework. Because this, I think I need to think about more carefully about the concept. But I think understand the capacity of service and the possibility to use the capacity of service can facilitate some analysis in the future. It's my thank you.
Thanks, Patricia. I think it underlines we need to bring out this point about whether you're using the asset to its full extent or not. And so that's communication, that's examples. And then I think it also underlines the terminology point as well that Lynn made. So I think we need to see that back and then check that that does adequately explain the debate that we've just been having. Scott, final comment.
Yeah, thank you, Ian. I raised my hand because of Adrian's comment. I was agreeing with what she was saying, and Lynn came in. To be honest, when I read this part of the paper, I got confused every time I saw the terms, and I could have easily flipped them and supported them either way. And I found out the more I read, the more I had to keep on coming back, referring to the definition, because I really couldn't follow what we're doing. I think potential is about the future and the current capacity is about the today. And so I got real confused. It'll be really interesting watching how the users would actually respond to this. But it's not clear to me what we're, in this perspective, and I could flip either one of these, and I could probably support it. So.
But I mean, going back to I think that we do tend in our standard suite to use social service potential, and that's the sort of so probably it's service capacity that needs taking out, and it needs to be dealt with, drawing on the Lynn's ideas there. I think that the overall sense I'm getting from members is we understand the recommendation that staff is making. I think that it is supported, but with that caveat that we've got to take service capacity out and discuss in another way how we deal with that concept. Okay, so I think before we move into back to 7.2.11, I think this is probably a good point to take our break. We're more or less halfway through. So if we take our 10-minute break now and come back at 25:02, David, and then we'll go into item 7.2.11. Okay, thanks everyone.
1 minute, 1 minute warning.
Just give a short while, and then I'll ask Dave to start. Okay, Dave, I think time's now up, so if you can lead us into item 7.2.11, please.
Thanks, Ian. So with regards to 7.2.11, this is where we compared replacement cost, which was a separate measurement basis in the measurement CP, with the cost approach, which was a measurement technique under fair value. And we did this partly because one of the comments we received in response to the measurement consultation paper was these appeared to be very similar concepts, and we should go through and identify whether we meant the same thing. And if we did, correct the difference between having one as a measurement basis and one as a measurement technique. So ultimately, we went through and we did this comparison. The conclusion we came to was the cost approach and replacement cost are consistent concepts. And we did that by reading the paragraphs of both. And it turned out that replacement cost really just clarified the two cost approach paragraphs that were in the fair value measurement basis. So our recommendation is that they are the same basis and techniques, that they're conceptually the same.
Okay, thanks, Dave. Succinct explanation for quite a complex topic. Okay, so take comments. Lucy, you're first.
Thanks, Chair. I agree that the extensive comparison between replacement cost and the cost approach provided under Appendix A shows that the underlying principles under the two concepts are consistent. However, in the light of our discussion on the terms service capacity and service potential, I think we have to look at this again, because in the comparison in Appendix A, it says the cost approach refers to service capacity, while replacement cost relates to service potential. So, because these terms can that these terms can be used in I mean, it is not clear that whether these terms can be used interchangeably, considering that the concepts are consistent. Especially the term replacement cost is used already extensively in our suite of standards, particularly in IPSAS 17 and IPSAS 21. So I think we have to consider the discussion on the terms service capacity and service potential when we refer to the cost cost principle. Thank you.
Thanks, Lucy. So what I'm going to do is I'll collect comments from members. So Camira will be next, and then Mark, and then I'll come back to Dave to respond to the points that members have been making. So I go to Camira next.
Thanks. Yes, following up on what Lucy mentioned, I think if the board decides to maintain the concept of service potential, just to keep consistency with all our standards and the terminology, that was like the main difference between replacement cost and the others. So that's why my question is, why don't we just maintain also the terminology replacement costs? Thanks.
Okay. Thanks, Camira. Go to Mark next.
Is when we look at the table 1, comparing these two approaches, we will find out that in the replacement cost approach, there are two things that in my view are not reflected in the cost approach, which is the fact that you will receive something from the disposal at the end of the life. And the other one is that while cost approach talks of obsolescence, replacement cost also talks about optimization, and I could imagine that optimization could be a bigger difference, because if you think, well, it's an old example, if you replace a telephone with a smartphone has many other functions. And in case of optimization, you would take these into account probably in the replacement cost. So I was wondering whether these two elements don't make a difference actually.
Thanks, Mark. Okay, Dave, back to you.
So with regard to Lutfi and Camira's point, something struck me, and this is on the last agenda item, when Scott indicated that he could take the definition of service capacity or service potential and interchange them, and he had to keep going back to the definitions. And I just go back to that because that was something the task force kind of mentioned as well. And one of our members actually said they were indifferent between the terms because if you translated them into his native language, they both translated into the same word. And as I thought about this over the break, what struck me was the tightrope that staff's trying to walk, and it's important for this agenda item as well, is that we're trying to maintain terms from IFRS 13, but still make them applicable in the public sector. And I know this wasn't an instruction, but it sounds like staff has been a little too rigid on how we're doing that. So for me, at least, the way forward is to go back and revisit a lot of this terminology and take a step back and see kind of how this works in the wider context, because that's, and I know I'm just repeating myself, that's the tightrope we've been walking, is trying to make all these terms work on both sides of the coin. With regards to Mark's point, I'll have to take that away and think about it unless David has views on it right now.
You don't, David?
Not right now, no.
No. Okay. So, I mean, essentially, we need to take this one away. And I think, Dave, you're right to refer to the fact that what we're trying to do with the measurement, ED measurement, is actually bring all these together. And so, inevitably, when ISB was only focusing on essentially, you know, the financial capacity exit values, you know, it had that perspective, and therefore in trying to align with that, but also bring a more coherent view, yes, I think we do need to have to, there may be cases where we need to change the terminology, and this may well be one of them. And also, I think from a user perspective as well, we need to use something that actually makes sense and is applicable for preparers and auditors in the public sector, so that we communicate what the concept actually is and it fits with the overall approach that we're taking. So I think on this one, therefore, it does sound like there is more reflection that's required, and we need to have a recommendation back on that, addressing the good comments I think that members have raised on this, and the good concerns there. Okay, so from a staff perspective, is there anything else you need from the board at this point?
No, Ian, I thought that was a good summary.
Okay, that's good, thanks. Okay, so then we move on to item 7.2.13, cost approach use, and this is you again, Dave?
Correct. So this is a similar paper and slide to what you've seen twice already. With the cost approach, and as Eileen said, when we were trying to determine where the cost approach was applicable, we looked at the attributes of the measurement basis. And in this case, we thought the attributes of current cost and fair value allowed the cost approach to estimate both those bases. With regards to current cost, because current cost is trying to estimate the amount that would be required to replace an asset, we thought that lined up very well with the cost approach. With regards to fair value, conceptually, the view is that even though the cost approach we think is more of an entry value and fair value is an exit value, conceptually, a market participant would never pay more than the amount that they could replace the asset with. So as a result, we thought that was how you got to cost approach being a good estimate for fair value as well.
Thanks for that, Dave. And obviously, you know, the answer to this is caveated by the piece of work that we've just asked staff to do. But in principle, our members, does anybody disagree with staff's recommendation on this? Lynn?
So I don't necessarily disagree. However, it did strike me now that we've got the description of cost approach, we're including the term comparable utility. So it talks about through the acquisition construction of a substitute asset of comparable utility. And I just wondered about that terminology versus what we've just discussed on service capacity, service potential, but also that terminology versus modern equivalent as well, which is a more normal term that's used when we're talking about replacement cost. So I think there is a bit more terminology just to nail down what we mean before I can sort of sign up to it being applicable as described in the paper. And the one on this paper was comparable utility to me.
Okay, thanks then. Okay, so I'm not seeing other flags up. So I think, you know, in principle, yes, but it's subject to that very big caveat that Lynn has expressed. And I think that's right, that we need to have a look at these pieces of terminology to make sure that they do actually hang together. And as you said, Dave, that may well mean that we do decide that we use a slightly different term when we're talking about this generically from IFRS 13 to underline that this is different, or that it is generic rather than the specific usage in 13. And we should allow you that license to think about that, think about terminology, so that we do actually square away these various different potential conflicts. And I think the other thing to recognise is that, I mean, as you know, Lynn used that modern equivalent asset. You know, there's a number of terms that people have sort of used in the past, and actually if we do define a new term which encompasses things, then I think we need to think about how we communicate that to our constituents. If we're discontinuing the use of modern equivalent asset, we need to be clear about how that's encompassed within the approach. Lindy, final comments, and then I'll move us on.
Thank you. And I guess it's maybe something to think about, or maybe not at a later stage, but I do wonder if we should just say, well, there's a generic approach to determining for the cost approach, and that's just all you apply. And whether or not we want to change it, if it's under fair value or if it's under current value, because it might just make it very difficult to develop the ED. And maybe then we just depart from IFRS and say, well, this is our generic cost approach, or cost, I get confused with the terminology, sorry. This is the generic technique, and you apply it that way and no other variations to it. I think it might actually help.
Thanks, Lindy. I mean, I think your comment is probably actually that we need to maximize the extent to which the generic techniques actually can be just dropped in and used. And it may well be just slight variants, like, for example, transaction prices or something like that, that you adjust for depending on the context and the basis. But I think that challenge is right, that we need to maximize the commonality and be very clear about why there is a difference of usage and what that is, if there is some sort of contextual thing in the appendices. Okay, good. So then let's round off this section on measurement techniques with paper 7.2.14. Dave, over to you again.
So this ended up being one of the most difficult things I did this quarter. Although I enjoy a lot of the conceptual discussions, and I think I guess it's the portion of my job that I really like. But when I was trying to pull everything together, we went through probably 4 or 5 different iterations of the ED, just trying to make it all work. We were trying to have core concepts up front. We were trying to reduce repetition. We were trying to have consistency throughout the AGs. And I think I listed 4 or 5 different ways we tried, and ultimately landed on a way forward that to me at least seems obvious now, but I didn't see it when we first started this. But the point here is that we did go through a few different iterations of this, and we did actually speak to some members when we were talking about other aspects and got their suggestions as well. Where we ultimately landed was we would remain consistent with the general outline proposed in the CP. And this is where we have application guidance for each measurement basis. And what we'd put up in the core text is the general principles for each measurement basis and the general principles for each measurement technique. And then when you get down to the application guidance, you have specific guidance on each basis and specific guidance on how you apply the measurement techniques to each basis. And I gave a few reasons why I thought this was a good way forward, but the one that really stuck out to me is the way it's set up now is the core text is just principles, and a constituent can just read the core text, and that is sufficient to understand the big picture. And if they have a strong understanding of valuation, they might not need to go to the application guidance, where the application guidance really supports what's in the core text. It took me a while to get here, but this is ultimately kind of where we landed and where I think the best place for the document to go is.
Thanks, Dave. So I think that the paper does set out the reasoning very clearly. I think the question is, does any board member really disagree with that and being clear about the reason for that? But we wanted to have the discussion now before you do a lot of nugatory work. Okay, anybody disagree? Lindy.
Thank you. So it's just a caution that if we're moving things around, we don't make it non-authoritative in doing that. So we just have to make sure the balance is still there, that if you're moving something out into another place where it was authoritative in IFRS 13, for example, now it's diluted, I guess, or it's changed its status. Thanks.
Thanks, Lindy. And just to confirm, Dave, if it is application guidance and that's authoritative on each of the bases?
Correct.
Okay, thanks for that confirmation. Mike.
Thanks, Chair. So I've been wondering when's the right time to raise this, and I think it's probably now. So I'm happy where we've landed. Thanks, Dave. And you made the point, you know, how to apply these different techniques and so on. My question is more about when to apply, and I'm thinking about all of the discussion so far has been what is the number going to be that's on the balance sheet, without any discussion about what the income statement impact might be. And I suppose, and I don't have an answer to this, I'm just making an observation. I found that after many years of auditing, we tend to use income approaches, which results in the asset being undervalued, which results in the profit and loss account depreciation being too low. We never replace the asset. If we use the cost approach, we tend to have a higher value, and you end up better managing your asset base, and you make better decisions going forward. So again, I'm not asking for an answer. I just think the focus has been perhaps too much on the balance sheet and not enough on the income statement.
Dave or David, do you want to comment on that?
I can come in, and I think a good place where this will come up, Mike, is, and I don't know what number it is, but in a few papers, John's going to talk about the measurement objective. And I think that might be a good place to hash this out a little more. But I agree with your point, but I think that's a good place to talk about it.
I mean, I think there is something here about that, you know, there is some further work that if you look at the list of issues, you know, it's a bit about where we originally, when we were doing the CP, we had the flowcharts idea and so on. So there is still some further thinking to be done. And also, you know, Todd's mentioned the hierarchy that you have in the appendix to IFRS 13. You know, do you need something similar? Do you need some generic guidance on how to think about it? So I think there is a bit more that's required. But also there is the overall thing here that actually we're writing principle-based standards, not rules.
Yeah.
And so whilst we can give a clearer way of thinking about all these issues, ultimately the application in particular circumstances is going to come down to that, you know, what's available by way of data to preparers, and then the discussion between the preparers and their auditors as to what actually gives faithfully representative information. So we are treading a tightrope here in terms of what we provide here. And so there is some further thinking that we haven't yet seen. But equally, I don't want to overpromise in terms of it won't give precise answers.
Yeah, and I don't want to overpromise either. So I suppose it's much easier if you're looking at a for-profit as against a not-for-profit entity. For-profit use future earnings or future cash flows, and they end up in the public sector utilities and water entities undervaluing their assets because they use future income streams when they know they can't get the price that they need. If it's a not-for-profit, you tend to use replacement cost, but we're offering other alternatives, which may be right.
Okay, so I mean, in terms of concluding on this item, Dave, support there from the board for the approach that you've taken, and I think probably for the reasons that you've articulated. And I do think that it is, given that we've had a discussion about this, there should be, you know, this is a board decision. It does need to be explained and articulated why we've you know, taken this approach. So I think, you know, in accordance with where we're going on decisions, we need some explanation on basis for conclusions that explains how we've approached this. And then there is the outstanding item on the usage or, you know, the thinking approach to different bases, which is one of the outstanding items. I think I'm right on the list for next time round. Is that right, Dave? Yeah. Okay, so that concludes the section on measurement techniques. We've now got some papers on measurement bases, so moving up a level. The first one is 7.2.15 on guidance on historical cost measurement basis. And I think, again, before we start this, we need to caveat this, that the sort of provisional approach we agreed on yesterday to take this forward on how we treat measurement on initial recognition will have a significant impact on this AG. With that caveat, Dave, do you want to go into the item?
So this is an item that I'll at least say when we started the quarter didn't appear to be a big issue, but coming out of the quarter and the papers you saw led to a number of other issues, one being initial measurement versus subsequent measurement. And I'll give a little background on how this became an issue and how we identified it. And I guess it came from a few different ways. One is when I was rereading the guidance that we had in the measurement CP, or the illustrative exposure draft. The guidance that we'd included in historical cost really focused on how to determine cost on day one. The second aspects came when I was reviewing ED 78 and looking at the guidance that we'd pulled out of there and moved into the illustrative exposure draft, and based on a comment we received in June to kind of take a step back and take a holistic view and see how it's all working together. And then ultimately, when we started having conceptual discussions based on these two observations, I don't want to say we realized, but we kind of crystallized that there was more of a distinction between initial measurement and subsequent measurement when you're in the historical cost model, because in the historical cost model, you're updating a day one value for current events. And we didn't really appreciate this when we're looking at the current value models, because whether you're measuring at day one or you're measuring on day two, the methodology is consistent. So what this all kind of leads to is it was a pretty significant rewrite of the guidance in the historical cost appendice. And right now, what we've proposed is to have a section on initial measurement and subsequent measurement and pull out a lot of the specific guidance on how to determine the cost of an asset on day one. Now, a knock-on effect to that, I think, addresses a board point from June that some of that guidance has moved back to ED 78. So I think that flows a little better as well. Before I turn it back over to Ian, his point that initial measurement now might actually be pulled out and put into core guidance, I think is relevant because we wrote this appendix, and I'd say after some members kind of saw it all together, that's when it was pointed out that maybe initial measurement was more appropriate in the core text. But with that caveat, we propose to make the application guidance more principles based rather than pull guidance specifically from ED 78 to say how you determine cost on day one.
Thanks, Dave. David, as task force chair, is there anything you want to add before I open for comments from members? And I think what I'm looking for is anything additional that wouldn't, get caught up in that rewrite that Dave's been talking about.
No, I don't think so. I mean, at the moment, I'm interested in hearing what people have got to say. I mean, I think a lot is made of the historical cost basis, and I'm not sure that necessarily everybody's got the same understanding of what the historical cost model is in practice as used today. So let's hear what board members have got to say, I think. Okay, thanks, David. So obviously we had quite a long discussion about this yesterday. Is there anything in addition that members want to say at this point, or is it a case that we actually need to see what comes back? Mike.
Thanks, Chair. So I'm comfortable with where this has landed. I just want, and thanks for doing the work, Dave. So where does deemed cost fit in when we don't have an historical cost, Dave?
So I don't want to get ahead of this too much because I think we still have to do some thinking on this, but I think where we landed yesterday, and I'm sure someone will correct me if I'm wrong, is on day one for historical costs, you use a transaction price, unless that transaction price doesn't represent the day one value, or you don't have a transaction price, then you would use a deemed cost, and deemed cost can be determined in a number of different ways.
Thanks, Dave. And I think this again falls into the category of we've talked about things loosely as deemed cost. Actually, this is being clearer now. We're providing guidance. So we may need to sort of, really move away from using that term going forwards, or we may, but that's where it fits. Okay, so I'm not seeing any other flags up. So I think, we need to see that come back, Dave. And that's linked to that. We need to see what it looks like when you actually write up the stuff on measurements on initial recognition. Whether that does genuinely work. Okay, so move us on then into 7.2.16.
So this is current cost. This is one of the items where I think, and you can leave this with staff, but we need to be crisper between the conceptual framework and ED measurement as to exactly what current cost is. But I'll go through a little bit as to what the genesis of this measurement basis is and where we're trying to end up to help members in making the recommendation here. When we were developing current cost, what staff was really trying to do was develop a current value measurement basis that could be applied more, or was more applicable in the public sector. And what I mean by that is we had a number of constituents come back to us and indicate some of the challenges in applying fair value in the public sector. Specifically, highest and best use, they said, wasn't always applicable. And calculating a current value measure from a market participant's perspective wasn't always applicable in the public sector either. And what they're really referring to is when you're holding an asset for its operational capacity, fair value wasn't necessarily the best measurement base. So that was really the genesis of developing current cost. Where we ultimately landed was initially we're looking at current cost generically for assets and liabilities. But as we kind of developed guidance, and we did actually develop a full guidance for current cost of liabilities, we concluded that we didn't think that would really be applied in the public sector for some of the same reasons that are outlined in the cost of release and assumption price paper. And we ultimately just landed on a current cost of assets, which is the cost of an equivalent asset. And the key here is this is from the entity's perspective. So our recommendation is that we go with the current cost of assets based on the concept that I just outlined.
Thanks, Dave. So open up for comments from members. Yeah, Camira, then Mike.
Thanks. Yes, well, as I mentioned in my one of my previous comments, I'm not totally convinced of the need of having a current cost as a separate measurement base. I think even if we are talking about, okay, different perspective, okay, from the entity perspective or from the seller perspective, and we are talking, okay, in fair value, we are talking about exit values, and in current cost, we are talking about entry values. At the end, I think, and even the appendix you are providing in this agenda item, it's like supporting the idea that current cost is actually a measurement technique or a way to calculate fair value. But well, that's my personal opinion on that. So thanks.
Thanks, Camira. Mike?
Yeah, look, I sympathise with what Camira is saying, and yeah, it's a good point, thank you. But mine was much more simple. Dave, it's to acquire the asset or to replace the asset or both.
Thanks. Dave, back to you.
So I guess, Mike, I mean, off the top, I would say I think it's to replace the asset, but I think this is a terminology thing that we need to make sure we're crisp on. So I think that's something we need to take away and make sure that we bring that back to you in a really crisp way.
I mean, I agree with you on that. I think that reflects very much back into the debate that we've just had. But on Camira's point, I'd reflect on a really difficult debate that we had in the UK on whether and how we could apply IFRS 13 in the public sector. And the real problem that we had was over the concept of highest and best use just not being applicable for things like roads, schools, hospitals. And I think that's why, you know, we do need something different, which is you know, what the staff have tried to encompass through the cost approach. Because when you accept the concept that you need to provide a service in a particular location, then highest and best use just doesn't work. So you're not saying that some of the same techniques couldn't be used in a different context, but it is a different way of approaching it. It's a different way of thinking about it. And so I think that's really why you need something that represents the operational side, the operational approach, rather than a market-based, you know, rather than the exit-based approach, if I can characterize IFRS 13 as that. And that is a bit crude, I recognize, but that's really why we, personally, I think we do need something different here. And whether it's quite articulated right at the moment, essentially the cost approach would be the sort of thing that we will be looking at. Personal view. I'll take views from Todd and Lindy.
Thanks, Ian. I think it is important out of this discussion that we are sort of aligned around what we mean by current cost. And I must admit, as I was going through these papers, I was confused at times about exactly where we were landing on current cost. And I think where I got to was it felt a little bit like we've got fair value with more of the exit price notion, you know, market participants and all of that side of things. And what we're trying to do with current cost is address sort of the two issues that you referred to, Ian, but perhaps try and replicate sort of the fair value, but taking account of, you know, it's not always about highest and best use and market participants, which is why I think I made my comment earlier about, are we likely to have a hierarchy that we would work through in a current cost sense, the same that we would under fair value. And I suppose I got myself to the point, well, if we are trying to replicate that sort of approach, but dealing with the issues that we see in fair value for some of the public sector transactions, then I might be able to get my head around that. But it wasn't clear to me that that was exactly where we're heading with current cost. And the most important thing is that we are on the same page, I think, in terms of what we're expecting with current cost coming out of this conversation.
Thanks, Todd. I think that's quite a helpful pointer for staff there, actually, in terms of thinking about it and articulating it, to think about what's different from IFRS 13. Lindy.
Yeah, and that was what I was going to say as well. I think it's one thing to argue at a very theoretical and say, yeah, it's entry exit. But I think when you get down to it, I think it would be useful if we know what are the key big differences. So it is highest and best use. And do we consider how we use the asset and economic obsolescence? And maybe we need those kind of key concepts of what would differentiate using current cost under the one basis versus the other, so that we understand, you know, what the differences would be. I still maintain maybe we just need one, and even if we depart from, but I think it is helpful in just our understanding and development. You know, you start with the high level conceptual argument, but I think what we got stuck at is, okay, but what actually is the real difference? And some of it comes out in the paper, but I think it's useful for us to have a cheat sheet really to understand what those differences will be and how it will be developed. Thanks.
Thanks, both. I think when you look at those comments together, that does actually help in terms of articulating what is different and then what the consequence might be in terms of how you think about it, which is Todd's approach. But I think that also probably goes to some of what Mike was saying as well, you know, in terms of to what extent can we give guidance to people on how you would approach this. And you know, the sort of hierarchy in the appendix to IFRS 13 actually does help you with that. It still leaves you with a choice, but it does give you, okay, I go to level 1 first. If I can't do level 1, then I go to level 2. And that may well be the sort of approach that we should think about here, as well as articulating. And I think those 2 points you picked up on, Lindy, are helpful. The highest and best use not being applicable. And also then it probably links back to that earlier discussion that we've just had, which is around service potential and whether that actually equates to the best use of, or the full use of that asset, or whether you've got surplus capacity there. So going back to Dave and David then, does that help you in terms of what the board is looking for in order to clarify the concept?
Well, yeah, yes, I think it does. I mean, it's given me a few new ideas, which I think we'll need to talk about with staff and you. And I mean, I like Lindy's sort of question over whether we actually do need something different, and that goes back to a point that Todd made. I think it might have been at the March meeting. It's where you take the, you know, going back to the point, you take the generic principles and then you nuance them for the situation that you're in. And we have been trying to do that. It's, as Dave would tell you, it's something I keep on telling them, you know, do we need to do that, or can we make it generic and nuance it? And so it could be that if we've got the license to move away a little bit from sort of slavishly copying IFRS 13, because don't forget, copy and align are two completely different words with completely different meanings. So if we can do that, it might be possible to make this a lot simpler. So I think I'd like to explore that a bit more. And also it's going through my mind as to whether or not we actually look at the way we present some of the appendices, and rather than sort of doing these, you know, what we've traditionally known as the replacement cost approach, or the this or the that, as to whether we go back to the sort of the generic of market income cost and sort of look at that in a different way. So I think it's been a useful discussion. So thank you very much to everybody.
Thanks, David. I mean, I think, you know, at the end of this, what we're looking for is something that works for our constituents. This is a complex area, and what we're trying to do is provide clear, useful guidance, and guidance that also links to what you would need to instruct your valuers to do. So we do need to take that approach so that it becomes practical and implementable. So if that means that actually we need to move away to an extent from what's already there in the literature or reuse that in a way, I think then that's a necessary consequence. Todd.
Yeah, thanks, Ian. Just one caution in terms of this discussion, and I think it comes back to, you know, the initiation of this project probably. It was around our use of fair value in our literature and wanting to make sure that where we use that, we mean the same as the IASB. And if I'm understanding, you know, lifting this to something a bit more generic, I just caution, given that that's where we started this project, I think we need to be careful that we don't end up in a situation where we change things so that we don't actually have fair value as it's defined by the IASB. So there's a bit of a caution in there, I think, and it will take some really careful thinking, I think, so that we don't end up in a situation where we're sort of going against sort of what we were trying to achieve, I think, in, you know, initiating this project and then bringing fair value in quite deliberately to be the same as where the IASB is on it. So just be careful.
Could I just that I have not said that we would ditch fair value. Right, the board has decided that we will import fair value. What I'm saying is we need to look at the way we present it and use it in a way that we can get over this big issue of highest and best use, etc. But we need to be flexible in the way we look at it without ditching the fair value requirement.
And I think, you know, that's where I've always found the table that staff produced when we were looking at what should come into ED 77, literally going through paragraph by paragraph against IFRS 13 and saying, where is this being used? I think that's a very useful accountability tool. And I think also we will need to present that as supporting material to our stakeholders when we go out to consultation, because remembering back to how we built the illustrative exposure draft, actually there are portions of what's in IFRS 13 that are very heavily linked to financial instruments, and you know, at that stage we agreed that they would go into you know, they would be put forward as consequential amendments to IPSASB 41 because that's where they belong rather than in generic guidance. So I think that's going to be one of the tools that's going to be really important, because this has to work supporting financial instruments and, you know, indeed our other guidance projects at the moment as well. So you know, we really need that as an accountability tool to hold us honest. And I think also, you know, the presentation we've got of ED 77 shows you where material's being picked up from. So if we have that detail level and the top level showing where the material has been used, and use that not only for ourselves but also for our stakeholders, that's really important. Mike.
So, Chair, thanks, Ian. I think what you're suggesting is a good idea, but remember, and whilst Todd's right, we wanted to end up with the same. If we're going to use the same term, we should define it the same way. But this was never an alignment project, and therefore we don't want to explain everywhere we may have varied from IAS 13, because we didn't start this off as an alignment project.
Well, it's really a hybrid, isn't it? You know, because it brings in IFRS 13 to the extent that it is generic and appropriate, but it also pulls in guidance from elsewhere, as we're finding, and provides additional guidance. You know, the area we've just been discussing, the current value, actually what it showed us is actually it's not well described in our current literature, which is why we're having the discussion we're having today. So, you know, I think it does a number of things, which is why it's a tough project, and it really is a tough project. Okay, so I think that's been a helpful discussion on current cost, and I think we've given direction to staff and the task force in terms of wanting to understand the rationale much more clearly, and then to come back to this. Now we have the next discussion on value and use, which is another thing that we've been kicking around. And we had that discussion last time round. John, you brought back a further a revised recommendation this time round.
Yeah, thank you, Chair. Basically, at the last meeting, staff proposed that value in use is a measurement technique for cash-generating assets and was not neither a basis nor a technique for non-cash generating assets. There was considerable debate on that and some pushback. Staff's looked at this again, come up with 3 options, which are listed in paragraph 4. And whilst there are arguments for each of those options, staff's recommendation is that the existing definition in the measurement basis, which covers both cash generating and non-cash generating assets, should be retained. Staff acknowledges that certainly as regards non-cash generating assets, there are practical issues, but that these are practical issues which are at a standards level rather than conceptual. And in making this recommendation, staff have been particularly mindful of the fact that any definition of value in use which excludes a reference to service potential will therefore exclude from this measurement basis a large proportion of the assets that the public sector entities for which IPSASB is designing standards are operated. So the recommendation is as on the slide, and as previously, through the chair, if I could ask for views on that, in particular where you disagree with the recommendation. Thank you.
Thanks, John. Okay, so I'll open the floor for comments at this stage. I would observe that I think there is one issue that came to me when I was reading the papers, which is that we did vary the definition that the ISB uses for value and use by including the reference to service potential. And so I think that does raise some questions, in terms of what this actually, that we've expanded the ISB's term. So I think there are some issues that need some further exploration there, at least. And that was something that only really came to me when I read the papers. But anyway, I'll open the floor for other comments. Patricia.
I agree with you. I think in practice, the difference when I measure the non-cash generated assets can be no relevant, because in relation to non-cash generation assets, the difference between I thought about the impairment test when I use the concept, the technique. It's only the potential services and transaction costs, because these, I think, in terms of costs and benefits of the information between between the fair value less sale expense and the value in use can be not so significant. But I think I think in general principle, for me, it's okay.
Okay, other comments? Because I think that point about impairment testing actually is quite interesting when you look at what's in there at the moment. A lot of the text in the AG that staff have produced actually is text from IPSAS 26. And I always forget which way around, but I think that's cash generating. But what it doesn't do is cover the non-cash generating situation. And therefore, I think it's bridging between the two situations, which is potentially a question mark. Okay, so I'm not sensing there's other comments. I mean, support there from Patricia, Todd, and then Lindy.
Yeah, I mean, I support the recommendation. I think it's important that it covers both the cash generating and non-cash generating assets. So I was happy with the recommendation.
Lindy?
Yeah, the same. Thank you. I had a look at the basis for conclusions in our current conceptual framework, why we included value for use, and that actually made sense. So I think we've already got it, and we've already got the basis for conclusions. So I think I support what staff is recommending.
Okay. So I'm obviously a lone voice on this. Can I, though, John, I think I remain of the view that I think we have to answer the question as to why did we depart from the ISB's definition? Because I think we have been very clear before that we use the same term when we mean the same term. Now we've had this on fulfillment value versus cost of fulfillment. The way in which the ISB defines value and use is different from ours because of service potential. Now, the question is, if we've just had the debate on cost of current cost and we've focused on service potential there, actually, do we need it expanded still? And I know that
the reason why we're including service potential is the same reason why we're including service potential in the definition of an asset. Because if we didn't include service potential in the definition of an asset, potentially we'd be ruling out a very large proportion of the assets, what are currently defined as assets, operated by non-commercial public sector entities. So my view is that it doesn't really differ from the approach we've taken to assets. And I think there is an issue of using terms differently, but value in use is so well established in the global literature that I think it is appropriate to modify the wording so that it reflects a public sector context.
Rick, but John, I'm going to come back on that because value in use is not used by the valuation profession. So, you know, I think we're not going to conclude this debate today, but I'm afraid I think there are some questions. And if we have current cost as a basis, then I question whether we need to add that into our, you know, expand an ISB definition to address something that's catered for elsewhere. Now, you know, this is just, we're refining things. So I think we need to, those are challenges that I'm just basically posing because of trying to square the various different things that we're trying to do here. You know, and I've used value and use as a term, but I think we're tying it down here. And so I think there are some further challenges that need to be looked at. I've got Mike and then Lucy.
Chair, so I've got the definition of the IFRS in front of me, and it only talks about estimated future cash flow. So I'm not hearing you say that's we want to, or maybe I am. If we don't have the definition at all, then we need to find a way to say it's going to be the same, or why does it need to be in the literature at all? But certainly we can't have a definition that only refers to cash flows.
Thanks. I mean, I'm actually saying we've used it in the past and we've broadened it, but actually if we've got something else that we're focusing on now as current cost, which actually addresses a certain set, then actually, why do we need to expand the ISB's definition on value and use? So that's the challenge I'm posing here. You know, and I think it just is, you know, and again, also from a user perspective, actually, if the valuation profession doesn't use value and use, it uses other techniques. You know, I think that's the challenge we just need to get over.
But is that a public sector specific issue, or is that a general issue between accountants and valuers? I've certainly seen that as the latter.
Well, I'll come back to David in a minute just to give some clarification on discussions. Okay. Lucy.
Yes, thanks, Chair. I tend to agree with the recommendation of staff that value and use can be used for both cash generating and non-cash generating assets. But I think we have to, well, as recommended earlier, I think we have to be really specific on when value in use can be used for of course for non-cash generating assets, because it says that when we speak of value in use, that is equivalent to the present value of the cash flows generated by an asset or a cash generating unit. So if we now apply it also to non-cash generating assets, then we really have to be specific on this, because we have to address also the consolidation, consolidation of financial statements for those which are using IPSAS and IFRS. So I think we have to be clear on this, perhaps in the AG and even in the IG and illustrative examples. Thanks, Chair.
Thanks, Lucy. David, just on the valuation point.
I've just done a search on the international valuation standards. There is not one mention of value in use. And we did have confirmation from David Tretton, who's on the measurement task force, that it has been dropped from the valuer's terminology some time ago. They don't use it as a valuation concept.
So there is a question then as to what do they use instead, recognizing that at the moment what we've got has two legs to it. One is in the cash generating environment, one is in the non-cash generating environment. So if they don't use value in use, how do they approach those situations, I think is probably the question. And we're not going to resolve it now, but I think it's useful to reflect on that and why they've moved away from it. Lindy.
But isn't it just that you would use whichever technique and you would just include the cost of sales, the proceeds from the sale? I mean, that's really the difference in the bases from the others, is the proceeds, what do we say? And the proceeds from the sale. So you would determine either using the cost technique and then the proceeds from the sale. So I think it's just how you operationalize it, or I'm confused. I don't know.
Yeah, no, I think you're exactly right, Lindy. Yeah. I think you're exactly right.
Yeah. Okay, so sorry, John, that does give you more work, and I know you've already done a lot on this, and apologies for that. But I think you know, it's better to just bottom out these challenges now. And I think we've got drafting, but I think we just need to come back. I mean, you know, clearly the majority of the board is supporting, but there are just still some things that we need to bottom out, I think, before clearing the recommendation. Okay, so with that, then we move on to well, it's a group of papers actually on other measurement bases, which the next one is 7.2.18, which is cost of release. And John, these are all yours, aren't they? Because they come from the conceptual framework.
Yeah, the next set of papers are measurement bases which are currently in the framework, and there's been a question as to whether they should be retained. The recommendation for each of these next three papers, 7218 on cost of release, 7219 on assumption price, and 7220 on net selling price, is that the measurement bases should not be retained. Given the time constraint, Chair, with your approval, perhaps we could sort of deal with them as a group and ask if there are any members who do feel that one or more of these measurement bases should be retained. That's cost of release and assumption price for liabilities, net selling price for assets, and the analysis of net selling price for assets was informed by the discussion on the project to align with IFRS 5, which was discussed in June, and where the board made a decision that net selling price should not be included as a complement or surrogate for fair value less cost of sale, cost to sell under certain circumstances. Thank you.
Thanks, John, and I think that is helpful grouping those. And just to confirm that these are all bases that the ISB does not have in its framework. And therefore what we're looking for is if we retain that there is a very clear public sector reason for retention.
Yeah, that's correct. The IASB does mention in its basis for conclusions cost of release and net selling price, and explains why they did not include them. They don't discuss assumption price, but it's not included.
Thanks, John, for that confirmation. So open it up. Does anybody disagree with the proposal to remove these? Yeah, Lindy, and then Todd.
It's interesting because it's just a question on assumption price, because isn't that like insurance accounting, and where there is IFRS 17, and we've used that in the social benefit standard. So we have pointed to it. I don't think we're going to have our own standard. Do we need to retain it just for that? Probably not, but yeah, we kind of do have it in our literature. I'm surprised if IASB doesn't, because they have two standards.
2 points there, if I may. Firstly, yes, if it does have relevance, that relevance is likely to be in insurance accounting. Secondly, we've noted that the ISB doesn't include it, even though it might be relevant to IFRS 17. Thirdly, the fact that a measurement basis is not in the framework does not mean that we won't necessarily use it for the odd standard. So I don't think that it's fettering the discretion of the board in future years were the board to decide to develop an insurance standard based on IFRS 17.
Thanks. So I've got Todd, then Mike, and then I'll come back to you. So John, I'll come back to you, and if you can pick up at that point on responses to Todd and Mike. Yeah,
certainly.
Thanks, Ian. Taking the three papers together, I'm not agreeing with the recommendation. I think I raised at the June or one of the earlier meetings that I think needs to be a high threshold for making changes to the conceptual framework. And I really don't have enough information to agree to remove some of this material. I've had the benefit of having some engagement with people that were involved in the discussions in the formation of the conceptual framework, that when I was, when they found out about this, they had some concerns. And I think to get me over the line in terms of why we would remove these from the conceptual framework, I need to understand more as to why we are. I mean, this is a conceptual framework. It's not a standard. I don't think it's a problem us having in our conceptual framework things that we don't currently use at a standards level. And I think to make a decision to start removing a lot of this stuff from the conceptual framework, I think we do need to understand why they were put in the conceptual framework in the first place and what might have changed to actually remove them now. And I don't have that information really from the papers to date, but it could be helpful to go back to a lot of the rationale at the time that they were put in and understand what has changed that would cause us to take them out now.
Thanks, Todd. I mean, just to push back on that, I mean, having been around at the time that the framework was put together, I think, you know, if you like, there was a lot of academic debate. And, you know, this goes back to 2010, 11, 12, 13, 14, all of those years we had the debate. I think we've now had the opportunity to use this in practice. And, you know, the other thing is that we do now have an increasingly complete set of standards. And so the question really is, if we haven't thought about using them, actually, really, why do we need them in the first place? And it's not that circumstances have changed since when we did the framework. It's actually just that we haven't used them. So why are they there? Why do we need them? And I think, you know, if we as a group of experts can't really come up with, you know, some fairly, you know, broad-ranging reasons why we should keep them, this is the opportunity when we're setting a standard. And by the way, if we were to keep them, then arguably we should be including something in ED measurement on them. Why do we keep them? And you know, that is, you know, I think John has included some of that thinking in the papers, and that was based on a discussion. I saw the exchange of emails with Ken Warren in New Zealand, you know, where I don't think Ken was at all ruling it out, actually. You know, so I think there is a real, we do need to think what would be the circumstances in the public sector that would justify us keeping it when the ISB hasn't got it, and they have updated their framework since 2014. So I think that's kind of, you know, I'm kind of looking at it from the other way, but I really am looking at it from I was there when the debates took place and we were kind of like, okay, this is an academic concept. Actually, if we're using this as a practical document, why do we need to keep it? So I've rambled on. I'll allow you to come back on that.
Yeah, and maybe this is a debate about what a conceptual framework should be. Should a conceptual framework just be about what we are doing now in terms of practice, or you know, the fact that it was quite an academic sort of process, is that actually helpful at the end of the day in terms of thinking about measurement and the breadth of measurement? Yes, you may not use it at a standards level right now. Whether you ever do, I don't know, but I think it comes back to what is a conceptual framework at the end of the day, in my mind, which is why I still don't feel like I have enough information to say we should be pulling all of this out.
Okay, but I think that's where I would say it's a tool for the board, and it's a tool for our stakeholders to use, where we've got, you know, there isn't something specific, but it's a tool. It's not an academic think piece. And I think that's, you know, having sat through the original debates, actually, we had quite a lot of academic debates, but in the end, actually, we tried to boil it down. I think measurement was the area where we didn't do a great job. There's a lot of politics backwards and forwards. But, you know, having sat through those original debates, I'm really not convinced we need this. Okay, so I think I've got Mike. Are you still in, Mike, or you want to go back? And then I've got Chris and David.
So look, I will comment, thanks. I came to this evening on Todd's side of the world. I thought that, this was a good the conceptual framework took a long time to develop, and there was obviously a lot of thinking went into it, and you and John were there authoring it all. But I'm having listened to your arguments, and I think because the ISBs updated their conceptual framework and have not referred to these items, I'm happy to take it out, but as long as we can bring them in at a standards level when we need to. So how do we make sure we don't forget about these things? Maybe it needs an SMC or a BC or something when we finalize these papers.
Thanks, Mike. So I've got Chris and then David.
Thank you, Chair. My contribution is that we are a public sector standard setting body, and our development of the conceptual framework should bear in mind the public sector interest. And I just like you've mentioned, these terminologies have been brought into the conceptual framework, but that is not enough reason to remove them. But the reason for the fact that the public sector environment does not even seem to envisage their usage. So why do we retain them? So I think we should just agree with what the staff recommendation is and move on. Thank you.
Thanks, Chris. David.
Thank you very much. I just remind board members that when we were developing the CP measurement with the illustrative exposure draft, staff did go through to see whether we could find any reasons why we should include in the illustrative ED any guidance on these particular bases, and we couldn't find anything to support their use. I'd also remind the board that the board has taken a decision that if a basis is mentioned in the conceptual framework, the board expects to see an appendix in the exposure draft on that particular basis. That decision has been taken. It's no good you nodding, shaking your head, Todd Beardsworth. And that the board did take that decision. I mean, you can reverse the decision, but if you want it in there and you want us to put something in, you have to give us some examples that we can base the guidance on.
Ross, before I go back to John for just a response on what's heard, in my mind, because I think, the challenge that is being raised, in terms of we need to demonstrate the reasons for taking something out, and there needs to be a clear debate and so on. I mean, Ross, in terms of we've already got something in the framework that we're proposing to take out. If our constituents came back to us with a really convincing argument as to why we should keep something, from a due process point of view, presumably we would just remain with what we've got in the framework if we were convinced by that.
Yeah, I think from a due process perspective, you wouldn't be up against it if you proposed to take them out because you didn't think they were going to be used based on the work on measurement, and noted that in the BCs, and then people came back and said, well, here's examples where I think you would want to use them, so you should retain them. It's already there. I think you can leave it in. And also to note, the framework is non-authoritative. So you've got a little more leeway there compared to an actual standard anyway. So I think the thinking is there. Whether you take it out or not, I think it's a practical decision the board's landed on based on the fact that you've gone through the measurement ED and where you're going to use measurement in the public sector, and you haven't identified use for these bases. So I think that's the basis of the decision so far.
Thanks for that clarification, Ross. I think that's helpful from a due process point of view. Mike, you wanted to come in before I go back to John?
Yeah, look, so I'm glad you asked Ross that question, but as long as it doesn't expose us to then having to re-expose.
No, I think we're in a different position where we already have something and we're proposing deletion to where we don't have something, and then, you know, we couldn't then suddenly write guidance on one of these bases without it being re-exposed. John, anything else you want to add to the debate that you've heard?
No, not a great deal, no. I think Ian's given the background to the inclusion of these measurement bases very clearly. Chris has asked the question whether there's a public sector context for retention. The only thing I'd add in response to Todd's challenge is that the reason some of these measurement bases were included was rooted in the in academic or quasi-academic models, the deprival value model for assets and the relief model for liabilities. And what that meant was there was an explanation of where they'd be explained by referring to the relationship between the different measurement bases. Personally, I was initially quite keen on retaining cost of release because I felt that the amounts potentially could be material, but I was challenged by members and the staff I was working with, and I had to put my hand on my heart and say, well, apart from the brief reference in IPSAS 19, which the ISB is considering deleting from IS 37, I couldn't think where this actually would be relevant. So that's the background. Responding to Mike, definitely I think we need specific matters for comment, either one or a grouped specific matter for comment where we are proposing deletion of a measurement basis which is in the current framework. And certainly I also think that the existing basis for conclusions will need to be strengthened and varied dependent upon the way we go. So that's my response.
Thanks, John. I think that background is very helpful. Linda, you wanted to come in.
Thank you. And maybe we should just leave it and then ask a question, say we actually do want to remove it. And I actually agree that with net selling price and cost of release, you probably have better techniques that you would probably use rather than these ones the way they are defined. And probably we'd look at them if you are in liquidation or counting or something like that, which is something that's not covered by our standards in any case. So it would be rare in those instances. And as I said, the insurance is also very rare that we would use. And so whether we want to include those for those reasons, I guess we could ask, or we could say, well, we're just not going to use them.
Thanks, Linda. So I mean, rounding up on this, I mean, I think clearly, you know, there are very reasonable concerns over this articulation as to, well, why was it in the original framework and why are we proposing deletion now? Ross has given us the due process point of view, if you like, that actually, if we propose deletion and stakeholders come back with strong reasons from a public sector perspective as to why we should retain, that we could retain, it probably makes sense from the point of view of a coherent package. And David's point around, you know, why would we retain something now, and you know, given that we've had experience and we're not including application guidance in ED measurement, that we do propose deletion, but that we articulate, you know, the thinking behind it, and you know, that we do have an SMC very specifically on this, which allows people to make the contrary argument. So it's always, I think, easier to actually really get people to focus on something by saying, look, unless you give us a good reason, it's gone, than actually saying, well, and I'm not sure how this works from a due process point of view, actually we might delete this, what do you think? So I think proposed way forward would be that we do propose deletion, we highlight very clearly the text that would go, we give the reasoning, and we ask specific matters for comment on this, so that allows people to come back and make the contrary argument for retention. Lucy.
Thanks, Chair. Earlier, I think Chris asked what is the role of the conceptual framework, and it says that it would provide a concepts. It underpins the concepts that should be applied in the standards. And I saw a look at the use of net selling price, and I found that we use that in IPSAS. I'm sorry, in B. Oh, I lost it. But I think I would just, my comment is that if we don't intend to use the concepts, then I think they shouldn't be in the conceptual framework. But let us rethink on the use of the net selling price. Maybe we can we may retain the net selling price, because we have been using it when we refer to when we refer it to PPE and E. So in BC6 of PPE IPSAS 17, we even use that term, and it says that the higher I'm sorry, the higher of an asset net selling price and its value in use. So IPSAS 17 defines the recoverable amount as the higher of the cash generating assets fair value less cost to sell. So it might have relations with the IAS 16 when it defines, when it used the net selling price as measurement basis. So maybe for the cost of release, we can exclude it from the conceptual framework, because we never use it and we never refer to it at the standard level. But for the other measurement basis, I think we have to reconsider our position of retaining them in the conceptual framework. Thank you.
Thanks, Lucy. I mean, I think, though, this is going back on the argument or the discussion that we had around the ED 79 in the June meeting, because I think, John, your paper did actually, sorry, I think it was Joe's paper, but you've drawn on that in your paper, you know, that kind of goes around this.
Well, my paper referred to the IFRS 5 alignment project, and if you recall, in June, there was an issue as to whether in assessing recoverability, where there's a negotiated price, rather than a market price, we should be including net selling price, and we decided not to. Net selling price isn't included in IPSAS 17. That's a distinction with IAS 16. The only other place in our literature where I could find something comparable with net selling price is IPSAS 12 on inventories, which uses net realizable value. So the assumption I made, the conclusion I came to, was that given the very sparing way it's used in our literature, that wasn't a justification for its retention in the framework. Had we come to a different decision in June, I think that the debate would have been more complex.
Thanks, John. So I think I have summed up on where I think the debate's got to, and that has got support from members. And Adrienne, unless there's a fatal flaw, we're over time now, and I really want to wrap up for today.
Well, let me be fast then. I realize that I think that the fact that something has been used only sparingly in the past is not a justification for dropping it from the conceptual framework. I'm thinking of the mess that...
Further, Jen, it's not the same concept. It's a different concept. So
I'm thinking of the mess that we may be in with COVID, where there is a lot more disorderly disposal.
Yeah, but I don't think any of that's relevant. Can we just look? I have wrapped up already. I've given a way forward. You know, so I think I don't want to carry on the debate. It's not fair to people. We've had 3 hours already. So I'm going to call the end of the debate at this point in time on this item. Now, we have 7 papers still to go through. We, I think, have had a lot of very good and constructive debates, and we've given members further direction. So what I propose is that we stick to the agenda as published for tomorrow. So we will go into the papers on ED 79, and then we'll also move on to ED 78 after that. What happens in terms of Friday, I think we'll need to see in the context of progress tomorrow, because I think on this project, we do need to cover the other papers as well during the meeting. So in terms of tomorrow's agenda, will be as advertised. We've got a meeting with staff after this. We'll see where we go in terms of Friday and also on the agenda on Tuesday. But tomorrow's agenda will be as advertised, but we'll make time to come back and complete this item on either Friday or Tuesday next week. So we're now over time in terms of today, so I'm closing today, and then we'll come back with the item on ED 79 first thing tomorrow. Okay, thanks everyone.